maybe let's start the session. Some people are still joining in, but nonetheless, we would start the session, and let's maybe start with a small intro. First and foremost, thanks everyone for taking your time out and joining this session. It's another session as part of our webinar series, Deep Dives with IIQF Expert, and these are sessions which we conduct regularly once or twice every month on important topics in our field of quantitative finance, financial engineering, risk management, uh, machine learning, data science applications in finance, banking, and all related areas. So today's webinar is on a very interesting topic. Um, Regulatory areas are anyway like again which are very hot areas worldwide, and we would be discussing today the evolution of credit risk, navigating the expected credit loss ECL mandate in India. And to present on this topic, we have Ritesh Chandra. Thanks once again, Ritesh, for joining in. So just to give a little brief introduction to Ritesh, Ritesh has done his CFA. He is an MBA from IIM Calcutta. He is a BTech from IIT Kanpur. And he has also earned the Sustainability and Climate Risk SCR certification from GAR, right? So his diverse industry experience includes leadership roles in various banks, Yes Bank, RBL, Barclays, where he successfully managed large credit portfolios and teams. Ritesh is an accomplished trainer and educator with more than 2,000 hours of training sessions delivered over the last 10 years. Plus, with 15 plus years of experience as a banker specializing in credit risk, trade finance, project finance, he brings a wealth of practical insights and hands-on experience to his training programs. He is also a member of the IMT Center of Distance Learning, Ghaziabad Board of Studies. So presently, he works as a freelance trainer and educator because of his love of training. So he has now moved into the full-time training and education space and he trains with various organizations, including our institute, Indian Institute of Quantitative Finance, College of Supervisors, RBI, Reserve Bank of India, Emeritus Program Leader for courses in AIML, CRISIL Academy Trainer for Credit Risk, Great Learning also, right? Where he teaches a course on digital banking and finance and for many other educational institutions. All right, so before I hand over the session to Ritesh, maybe a very brief guideline on how we would proceed with the session. So the session, as you all know, is for about 1 hour, where we will be speaking on the topic of the day. And then post that, we would be having a question and answer session. So please keep the questions flowing. We want the session to be interactive. So at any point of time, you want to ask anything during the session, I mean, now, if you have any specific questions regarding today's topic, you can ask that as well during the session. I mean, you can ask the questions, while hearing the session as well, or post the session. Whenever you feel that you need to understand anything or you have any queries, questions, so please feel free to type in the chat window. Since there are again a significant amount of participants, so it's very difficult to manage. So everybody if we allowed to speak, right? So unfortunately, the participants will not be able to speak. But nonetheless, you can always raise your questions in the chat window, and we would be trying to take up all questions in the Q&A session, right? So yeah. I think with that, let me hand over the session to Ritesh, and maybe Ritesh can take
give me a minute, Nitish. I will start. Give me a minute, just.
No worries, no worries. I'm just making you the presenter, so whenever you are ready, you can start the session. Yes, Ritesh. So you are the presenter now. So whenever you are ready, please feel free to start.
You have made me the presenter? Just a second.
Yes. Are you able to share your screen?
Just a moment. Can you see my screen?
Oh, no, not yet.
Just a second. Yeah.
Yes, we
Can you
can
see
see your
that?
screen. Yep, absolutely.
Okay. So thank you very much, Nitish, for inviting me to conduct this webinar, and welcome everyone, and thank you for taking out your time on a Saturday afternoon
Yeah,
kind of
we are
thing.
not able to see you though.
Just a sec. Am I visible?
Yes, absolutely.
Okay. Just a sec. Okay. So welcome everyone, and I will start right away. Uh, the whole idea we are conducting this session on ECL, or expected credit loss system, is, as you would be aware, this is a part of IFRS 9, which has been implemented globally. The Indian derivative of IFRS 9 is Ind AS 109. And while our corporates have already implemented that framework, as far as it goes for our banks and financial institutions, it still was not there. RBI came up with the final master directions on 26th of April 2026, where they have said that from 1st April 2027, the ECL framework would be mandatory for all scheduled commercial banks in India. And now there is a big buzz around it, because it is no longer something which will happen somewhere in the future. It is something which now has a tangible deadline or a timeline where it has to be met. Now, before I start talking about the details of the expected credit loss framework, which is part of Ind AS 109, a big question is, why does this standard exist at all? Now, ECL has not emerged from some academic theory or academic exercise. In fact, ECL was a direct response to a failure which cost the global financial system trillions of dollars. Now, before 2018, when it came to banks and financial institutions, so now you realize that one of their primary risks is credit risk, that the borrower will not repay the loan on time, and therefore they are required to make provisions against expected losses. Now, what are these expected losses? The idea is, when you make a loan to a group of people, to a certain category of people or borrowers, some loans are bound to go bad. So in banking, we don't consider it actually a loss, we consider it as a cost of doing business. It's very similar to, if you are an insurance company, if you are an insurance company and you underwrite a portfolio, say, of automobile loans, you know from day one that some of the policy holders are going to claim under the insurance policy. So similarly in bank, you know that some of the borrowers are going to go bad, and you are required to create a provision for that. Okay. Of course, the default rate does not remain constant from year on year. There are periods when the macroeconomy is doing good and the default rate is lower than the long-term average. And then there are periods when the economy is not doing so good and the default rate or the credit losses go beyond the long-term average. So that long-term average is the expected loss, and there are years when your actual credit losses are more than the expected loss, and for that the bank needs capital. Okay, so that's the difference or distinction between expected loss and unexpected loss. Expected loss is managed through provisioning in the P&L, where you are saying that a part of my profits have been set aside to account for future losses, because some of my loans in my portfolio today are bound to go bad. And then you say, I also need capital so that if there are unexpected losses, the bank can still meet the demand of depositors. That is what it is in a nutshell. Now, before 2018, if you look at the global standard, global level, the dominant accounting standard was something called IAS 39, or what we call in India, the incurred loss approach. So if you look at the incurred loss approach, I'll give you the Indian example. In the Indian example, what is the standard definition or the regulatory definition of a loan turning bad? We call it an NPA, a non-performing asset, or a substandard loan. So the regulatory criteria is that once the loan has been overdue for more than 90 days, that means it is 90 days past due or 90 DPD, then the loan is qualified or classified as a substandard loan. And the provisioning that you have to make against the loan jumps significantly. So till the loan is standard, that means it is within 90 DPD, the average provisioning that you have to do against a standard loan is only 40 to 50 basis points. But once the loan becomes substandard, the provisioning jumps straight away to 15%. That's a huge jump in provisioning. Now, the problem with the incurred loss approach is the bank recognizes the additional provision. That means they recognize that the quality of the credit has deteriorated only when you have an objective evidence that a credit event has happened. And the definition of the objective event is 90 days past due. Okay. It could be a missed payment, it could be a bankruptcy filing, it could be a formal restructuring, but the event must have already happened, which means the whole incurred loss approach is a backward looking approach. Now, what we saw earlier is this incurred loss approach does something very critical. It results in provisions which are too little and too late. And this is what we learned from the financial crisis, where the banks knew from their internal data that a portfolio of subprime mortgages was deteriorating. The loan officer knew that the portfolio was deteriorating. The risk department knew that the loan portfolio was deteriorating. But accounting rules told you that you don't need to book a loss until and unless the loss event has actually crystallized. Okay. Let's look at an example. This will make it more clear. Say there is a US bank with a $10 billion subprime mortgage portfolio, which they originated sometime in 2005, 2006. By mid 2007, the housing market was showing signs of declining and housing prices had started to fall. Of course, delinquency rates started to go up. Now, the bank's internal models showed that expected credit losses were increasing, but under IAS 39, because the borrower had not yet formally defaulted, the reported provision was still very low, say only 2%. So on a $10 billion portfolio in 2007, when the housing market started to show signs of slowing down, the bank booked the provision of say only 2%, which is $200 million. But by the time the formal defaults materialized in 2008 and 2009, on that same $10 billion portfolio, the actual loss was around say $2 to $3 billion, which means the provision that you booked earlier was too little and too late. And if you multiply this across every single bank, now you have a systemic financial crisis, which is exactly what happened during 2008, 2009. So having looked at this, the G20 group of nations and the Financial Stability Board, they decided to fix this problem, and IFRS 9 was introduced in 2014, and it was made mandatory from, I think, 2018, January 2018. So the core conceptual shift in IFRS 9 is, unlike the incurred loss model, where the bank has to book a large provision only when there has been a formal default, that is the 90 DPD definition, IFRS 9 tells you that instead of waiting for the loss to happen, bank has to act proactively. It has to estimate and provision for losses which are expected to occur. So it doesn't mean that you have to ultimately wait. For example, in the Indian context, if you have a term loan whose repayment is due, say, after 60 days, and the company goes and files for bankruptcy under NCLT. Now, under the current approach, first of all, the payment which is due to the bank after 60 days has to be missed. Then the account will start appearing in default. And then the default has to persist for another 90 days. So the account will become substandard only after 60 plus 90, 150 days. But under IFRS 9, it tells you that the moment the company filed for bankruptcy, now you know that your payment is not going to come, and therefore you have to provision proactively. So that is IFRS 9, and its Indian counterpart is the Indian Accounting Standard, or IND AS 109. We issued IND AS 109 in India in February 2015, if I remember correctly, and it has a lot of convergence with IFRS 9. So while it has been applicable to corporates in general, as far as its application to banks and NBFCs is concerned, that is governed by RBI. And now RBI says that they also have to comply with this standard from 1st of April 2027. So that is the whole genesis behind IFRS 9, or the expected credit loss framework, or IND AS 109. Okay. Now, what do you mean by expected credit loss? The idea is very, very simple. It tells you that across every period, you have to take the product of the probability of default, exposure at default, loss given default, and you have to multiply it by a discount factor. So these are the four terms: the PD, the LGD, the EAD, and the discount factor. The most important component here is PD. This is the likelihood that the borrower will not meet their contractual obligation within a defined horizon. Now, the concept of PD sounds very straightforward, but when it comes to the ECL framework, there is a nuance. In the ECL framework, a borrower has to be categorized under three different buckets: stage 1, stage 2, and stage 3. The idea is, as the loan quality keeps on deteriorating in the estimation of the bank, the borrower will move from stage 1 to stage 2 to stage 3. And of course, the expected credit loss that you have to book and the provision that you have to create, that also keeps on progressively increasing. Now, in stage 1, the probability of default that you use is a 12-month PD, which means you try to model what are the events that may lead to a borrower default over a 12-month horizon, and you use that PD to calculate your expected credit loss. On the other hand, once the borrower moves to stage 2 or stage 3, now you need a lifetime PD. Lifetime PD means the probability that the borrower may default any time during the balance tenor of the loan. So if you have a 20-year mortgage and it has moved into stage 2, then you will require a PD estimate for year 1, PD estimate for year 2, PD estimate for year 3, all the way up to the PD estimate for year 20. So that is one thing. Secondly, the probability of default that you have to use for the expected credit loss framework, that is not a through the cycle PD, it is a PIT or a point in time PD. So as some of you must know, TTC or through the cycle PD is what the external rating agencies typically use. It essentially tries to assess what will be the borrower's credit worthiness or the probability of default across the economic cycle. So the macroeconomic factors that you consider, they have been averaged across the economic cycle. But for a PIT, you essentially give weightage to what can happen to the macroeconomic environment over the next 12 months. You are not bothered about what will happen across the economic cycle. Okay. Now, how does this play out in the real world? So suppose you are a borrower, your CIBIL score is say 720, and you have taken a 50 lakh rupees home loan. Based on the bank's internal model, which has been calibrated on historical mortgage data, the bank will give you, say, a 12-month probability of default of 0.8%, which means for every 1,000 loans with this profile, that means matching your profile, at this point in the economic cycle, 8 are expected to default in the next 12 months. That's what it means by a PD of 0.8%. So for stage 1 ECL, you will use 0.8%. But the moment the borrower slips into stage 2, now you need to construct a full PD term structure, or what you call a PD curve. So the question you will ask is, what is the PD in year 1? What is the PD in year 2? What is the PD in year 3? And you will aggregate them across the remaining life of the loan. Okay. So that is about the PD. LGD, we all know that is the fraction of exposure that you expect to lose if the default happens. Depends on collateral, depends on the legal environment, depends on the recovery cost. EAD is very simple. It is the amount that is owed to the bank at the point of default. And then there is a discount factor. So IFRS 9 or IND AS 109 tells us that the expected cash flows have to be discounted at something called an effective interest rate, which is the rate. Now, this effective interest rate is not the current market rate. No. It is the contractual rate which is embedded in the loan at the time of origination. That means when you originated the loan, say you gave the amount of 100 rupees to someone with a repayment schedule. Now, the question I'm asking is, what is that embedded rate of return such that if I discount all the future repayments at that particular rate, its present value becomes equal to the amount of loan that I am giving to the borrower today. That is what it means by effective interest rate. So effective interest rate is not the current market rate. It is the contractual rate that you have embedded in the loan at the time of origination, and it must be applied consistently over the entire life of the loan. So if you look at the formula in layman terms, the formula is asking you at every point of time in the future, what is the likelihood that the borrower will default? And if default happens, what fraction of the exposure we end up losing, that is the LGD, and how much is that exposure, that is the EAD, and what is all of that worth in terms of today's money. This question you are asking at every future point of time. And then you take the aggregate of these over the entire life of the loan, and you have the expected credit loss. Okay, you have the expected credit loss. Now, I'm just showing you here how do you actually calculate it in a real world scenario. So you have a loan amount of 1 lakh, 3-year amortizing, effective interest rate 6% per annum, LGD of 45%, and you compute the marginal probability of default for every year. Now, in every year, you will take the EAD, the LGD, and the marginal PD, you compute the nominal loss, and then you discount it using the effective interest rate. So you get the discounted ECL. This is a 3-year loan, so you aggregate the discounted ECL, and the overall ECL is 3,000 rupees for that 1-year loan. So this is how you will actually compute the ECL in the real world. Now, the formula is very clear, but in real life, you will find that the PD, or the probability of default, is one of the inputs that is very difficult to get right. And why? Because there are two very different ways of measuring the probability of default. So under the Indian scenario, for example, where the capital charge for credit risk is computed using the standardized approach based on the external rating. Every bank still has an internal model, but the Basel II or the Basel III internal models which banks typically have, and this is a situation peculiar to India. When it comes to global banks, they are all under the internal model approach, which means they use their own internal models to actually calculate what is the regulatory capital they should keep. In India, RBI does not allow that. So regulatory capital for credit risk still is driven by external rating, but banks also have their internal rating models. Now, if you look at those rating models which banks normally have, these rating models are typically through the cycle PD, which means you are looking at the performance of the borrower across the economic cycle. Okay, that is the correct approach for regulatory capital. Why? Because you need capital to be stable and counter-cyclical. You don't want banks to cut lending every time the economy is going through a bad phase. So for regulatory capital, a TTC PD makes sense. But IFRS 9 requires point-in-time PD. Why? Because the entire philosophy now changes. For provisioning, the philosophy is that the amount of provision that you have kept should reflect the current economic conditions and what is the expected trajectory of those conditions. So if the economy is in a recession, the PIT PD should be on the higher side than the long run average. And if the economy is in a boom, then the PIT PD should be lower. Okay. So for the same borrower, the PIT PD during a downturn might be, say, double the TTC estimate. The TTC estimate is, say, 0.8%, and the PIT PD estimate is, say, 1.6% during a downturn. In a boom economy, the same PIT PD might become only 0.4%. Okay. So that is the challenge which banks will face, that now they will need to have these PIT models implemented within their system. I'll give you an example to illustrate this. Suppose you have a mid-sized Indian bank with a retail mortgage portfolio. Now, its Basel compliant internal rating based model will produce a TTC PD of, say, 1.2% for their standard home loan product. Now in FY20, in March 20 or April 20, when we were grappling with the COVID shock, the actual default rate on the home loan products might have shot up to say 2.8% versus the TTC PD of 1.2%. Now, if the bank feeds the TTC PD of 1.2% into their expected credit loss calculation, then it is using a number which is less than half of the actual default that the bank is experiencing, and the resulting provision will be materially underestimated. Okay, so that is the dilemma or the challenge which the banks have to face, that they now have to distinguish between two different kinds of probability of default, and they have to specifically use a PIT PD when it comes to ECL modeling, whereas for regulatory capital modeling, the TTC PD will work. Okay. The second important aspect of IFRS 9 or the ECL framework is that every financial asset which is subject to impairment, that means its quality will deteriorate, has to be put under one of the three stages. So stage one is the default position. By default, I mean the standard position for any performing loan which has not experienced any significant increase in credit risk since origination. So for this, the bank needs to compute a 12-month ECL, which means the expected loss from default events which could occur over the next 12 months. Okay. Now, if you have a well-diversified portfolio in a stable economy, the stage one ECL will be relatively modest. The challenge is the other two stages, stage two and stage three. Now, stage two is when the loan has started experiencing a significant increase in credit risk since origination. It is not yet NPA, it is not yet credit impaired, but you are observing some kind of a stress, say 15 plus DPD or some other things. When you move the loan to stage two, now the ECL is no longer the 12-month ECL, it is a lifetime ECL. That means the full expected loss across every remaining period of the loan's life. So if you have a 15-year mortgage originally with balance or residual tenor of say 12 years with monthly repayment, then you actually have to estimate the PD, LGD and EAD for each of the 144 monthly periods and compute ECL for each of them on a discounted basis and then add them up to find the lifetime ECL. Why it is so important? Because the moment you move from 12-month PD to a lifetime PD or from a 12-month ECL to a lifetime ECL, the amount of provision that you will have to carry in stage two might be 5 times, 10 times, or 20 times the provision that you were carrying for the same loan in stage one. And stage three is when the loan has become credit impaired. That means default has happened or it has become imminent. Again, you have to use lifetime ECL. Okay, but there is a critical change at stage three. In stage three, how you calculate the interest income, that methodology changes. So instead of applying the effective interest rate to the gross carrying amount, interest is applied to the net carrying amount. That means the balance after reducing the provision, which has a direct and a material impact on the NII or the net interest income for the bank. Okay, so this is fairly technical stuff. We don't need to get into all that at this stage. Important thing for you to remember is the moment we move from stage one to stage two, the provision that the bank has to carry can be significantly high. And what all can trigger the stage 1 to stage 2 movement? So we call it SICR, or significant increase in credit risk. Now, IFRS 9 deliberately does not prescribe a very objective rule. The standard tells you that you need to exercise judgment, which is supported by qualitative and quantitative indicators. So I've shown you on the slide some of the triggers which might lead to SICR, or significant increase in credit risk, and therefore a movement from stage 1 to stage 2. In my opinion, the most common quantitative approach which people take to make that judgmental call is they will compare the probability of default at the time you originated the loan, versus the time, the current date, when you have to do a RBI reporting. And typically two variants are used. One is an absolute trigger, where if the current PD exceeds the origination PD by more than a defined threshold, say 50 basis points, then the loan will be migrated to stage 2. Or there could be a relative trigger, where you say if the current PD is more than double the origination time PD, then I will move it from stage 1 to stage 2. And of course, you will also have qualitative triggers which will supplement the quantitative assessment. For example, a loan which has been restructured, or which has been granted some kind of a payment moratorium, automatically becomes a stage 2 loan regardless of its PD movement. The very fact that a restructuring has happened means that there is a significant increase in credit risk, and you have to migrate the loan from stage 1 to stage 2. Uh, if you look at the RBI circular, there is a backstop which has been provided for this, the 30-day backstop, which is called a rebuttable provision. This essentially means that significant increase in credit risk has occurred if a loan is more than 30 DPD, what you call the SMA1 in our current scenario. So the circular says, or the guidelines say, that once the loan is past 30 days due, you automatically assume that it has to be migrated from stage 1 to stage 2, but it is rebuttable in the sense that the bank can argue against the presumption if the bank has a compelling evidence that the days past due status does not reflect a genuine deterioration in credit. For example, the bank may argue that there has been an administrative delay in some payment processing rather than actual financial difficulty at the borrower's end. Okay, and similarly, you have the 90-day default presumption. That also is something which is rebuttable. Okay, so that is about the SICR. Now, RBI regulatory architecture, if you look at this, so this simply shows you how the IND AS 109 adoption timeline in India has evolved. And the idea is, as far as the banks are concerned, from 1st of April 2027, they have to be brought under the ECL framework. I can leave this one. Now, let us look at a more interesting part in terms of how the ECL framework will be operationalized in the Indian context. Now, a lot of people think that ECL implementation is similar to a financial modeling or a credit modeling project. It is not. It is a truly cross-functional exercise. The modeling part is only, I think, 35 to 40% of the work. The other 60% of the work is quality data, systems, governance, and validation. So if you ask me to define how the ECL framework will actually get implemented in the banks, I would say that it has to be considered in three layers: the data layer, the model layer, and the reporting layer. Data layer is the foundation. You need the loan level historical data, ideally at least 10 years, with consistent identifiers, origination characteristics, and monthly status flags. You need macroeconomic time series, GDP growth, unemployment rates, property price indices, interest rates, and all of them at the right frequency. You will need data lineage documentation so that an auditor can trace every number in your ECL estimate back to a source system. And you will need the data to be structured as a panel data, where each row will represent one loan at one point in time. Why? Because the survival analysis models which you require for lifetime PD estimation, they actually require panel data. So that is the foundation of the data layer. On top of that, you need the model layer. For retail portfolios, the PD models will typically use logistic regression for a 12-month PD when it is in stage 1. And for stage 2 and stage 3, you will need what you call survival analysis. The most popular one is the Cox proportional hazard models for lifetime PD. LGD models will again have a two-stage approach. One will be a cure probability model, and then you need a loss severity regression for cases which cannot be cured. And EAD models will estimate credit conversion factors for off-balance sheet exposures like OTC derivatives, trade finance, LC, BG, lines of credit. And you will need a macro overlay model which will link the macroeconomic variables to PD and LGD. That is for a retail portfolio. For wholesale banking portfolios, you will, instead of taking individual loan level models, you will use what we call transition matrices, which will tell you what is the likelihood of a particular exposure moving into some other rating category towards the end of a given time horizon. Now, each of these components, that means the retail portfolio components and the wholesale portfolio components, they will need to have their own validation requirements. They will need to have their own documentation standards, and they will need to have their own backtesting protocols. And finally, you have the reporting layer, which is the ECL calculation engine, which will aggregate the PD term structure, the LGD estimate, the EAD amount at loan level, and you will roll them up to the portfolio level and the entity level. So at the reporting layer, the model output becomes a financial statement number for the bank. So you have the ECL calculation engine, and you have the staging engine, which will run the SICR, or the significant increase in credit risk assessment, for every loan at every reporting date. And you will have and you will require a financial reporting integration, which will ensure that the ECL movement is correctly flowing to the income statement and the balance sheet line items. And finally, you have the management information layer, which will have the dashboards and drill downs, which will allow the risk managers and the CFO to understand what is driving the provision movement in the bank. The critical point here is all these three layers have to hold for the framework to succeed. If you have a technically sophisticated PD model, which is the model layer, but it is sitting on top of incomplete data, then it is going to produce the wrong number. Or if you have a clean data set, that means your data layer is good, which feeds into a good model layer, but At the reporting layer, you have a staging engine which has some logical error. Again, it will produce a wrong stage assignment. So it's not only the individual layer, the chain overall matters. Okay. And finally, I want to talk about, spend a few minutes talking about how the institutional landscape is expected to evolve as far as the ECL framework is concerned in India, and what kind of career opportunities it can create. So, see, the ECL model work in India will typically sit across three types of institutions. And each of these categories of institutions will have a very distinct demand. The first set is the Indian scheduled commercial banks, the large private sector banks and the public sector banks. Private sector banks, I think right now are slightly ahead in their IND AS 109 journey. They have internal model teams in place, they have validation units in place, and their data infrastructure has, over a period of time, become more sophisticated. Public sector banks are in a slightly earlier stage of capability building. Okay. And the data environment there might be a bit more primitive. So the work at the Indian scheduled commercial banks is the domestic portfolio work. Indian borrowers, Indian macroeconomic scenarios, and IND AS 109 compliance. Then you have the large NBFCs, the housing finance companies, the microfinance institutions, the diversified lending NBFCs, which have live production ECL models. The modeling complexity for the NBFC is generally lower compared to banks because their product structures are simpler. They have more homogeneous portfolios, but even with them, with the NBFCs, the data infrastructure challenges can be quite significant. And finally, you have the global capability centers or the GCCs, which are the Indian subsidiaries or Indian offices of global banks like Stancy, Barclays, Deutsche, HSBC, Citi, JP Morgan, GS, Goldman Sachs. Here the work is non-Indian, US, UK, European, and the regulatory framework is IFRS 9 from the parent's perspective. So if the parent is a UK or a Europe-based bank, it is typically an IFRS reporting perspective. And if the parent is a US-based bank, then it is the CECL framework in US. And the regulatory scrutiny there will not be from RBI. It will be from the FCA, PRA, ECB, and the US Fed. The methodological requirements in the GCC will be more demanding. You need to have full risk survival analysis. You need to come up with complex multi-scenario macro frameworks. And you also have to do stress testing over and above ECL estimation. So the technical bar is relatively higher. And that gets reflected in the compensation that these GCCs are willing to offer to people who have the skill set. So if you have a model developer or a validator who is sitting out of a GCC in Pune or in Bengaluru or in Chennai, and they are working on a global IFRS 9, then the skill set required is the same as the work that they have to do as their counterpart in London or New York. Okay. So this is what the different types of institutions are. And I put up a last slide which just talks about what are the quant and accounting skill matrix that you need to survive or succeed in the ECL world. See, the main feature, in my opinion, as far as the job requirements for the ECL market are concerned is ECL requires an intersection or overlap of skill sets which many academic programs are not geared up for. So you require a statistical modeling skills, you require regulatory accounting knowledge, and you require programming proficiency, and all of them simultaneously. Okay. If you come to the statistics and the econometrics layer, you need to know logistic regression to calculate 12-month PD. But you also need to be able to do survival analysis, like a Cox proportional hazard model for lifetime PD. You also need to know regression diagnostics to identify model misspecifications. You need to know the generalized linear models of the GLMs for LGD. You need to know things like Hosmer-Lemeshow. You need to understand why a metric like area under curve is measuring a certain different aspect of discrimination. And you need to know something like Schoenfeld residual plot and what does it tell you about violations in the proportional hazard model. So these are fairly technical stuff. Then you have the Python or the R layer where you use pandas for data manipulation and panel construction. You use libraries like sklearn, scikit-learn, and stats model for model estimation. You use lifelines library for survival analysis. You use the scientific Python for statistical testing. Okay, and one of the key abilities at the Python layer is the ability to produce reproducible analysis pipeline. The idea is your pipeline is one which a validator or an auditor can produce independently and they can audit it. Okay, so this is not similar to saying that I know Python in a general sense. No, this is more like knowing scientific Python ecosystem and then apply it to financial modeling. And then you have the accounting layer, the IFRS 9 standard text, where you need to know which paragraphs govern the decisions of a bank, which are the paragraphs which are applicable to stage 1 ECL recognition, which are the paragraphs applicable to the 30-day rebuttable backstop, which are the paragraphs applicable to the 90-day resumption, how does the effective interest rate calculation happen and why does it matter, and how the entire ECL movement will flow through the P&L. You have to know all this. And then you have the regulatory layer, which is the Basel III IRB framework, because many of the ECL models, especially in the GCC world, they will be built on top of or the existing IRB PD models. And you have to understand how they differ and what is the distinction between them. And finally, you have the communication and the documentation layer, where you are responsible for writing model documentation to the MRM standards. You should be able to present model results to a credit risk committee, which many a times include non-technical people. And you should be able to explain why a provision has moved in a certain way, which distinguishes genuine credit deterioration from a model artifact. So these are, in my opinion, the 5 different set of skills that people will need to have. Of course, it's possible that someone does not have all the 5 skills. You can have 1 or 2 of these skills and you make a career out of that. Okay. And based on what I understand from talking to people, when people are interviewing candidates for an ECL related job profile, I think normally strong candidates have 3 different characteristics. The first one is an evidence of end-to-end model build. So if you simply say, I know logistic regression, that does not cut the ice. You should be making a statement like, I built a PD model on loan level panel data, validated that with KS and Hosmer-Lemeshow, and I produced a PIT adjusted PD term structure. The idea is that you should be comfortable with end-to-end model building. not simply saying that I understand what logistic regression is. The second one is regulatory fluency, where you simply don't say that I understand the staging criteria in IFRS 9. You should actually be aware about the different paragraphs in IFRS 9 and what they mean. And the third, this I mean, is very important, especially in the Indian context. That is the fastest, one of the fastest growing markets in India, validation. And you need to have a validation mindset. So validation is about how you can do an independent review of models which have been built by others. Now, to be a good validator, you need the same technical skills as the developer, the people who develop the model. That is given. But over and above that, you also need a adversarial instinct, meaning given this model's output, what is most likely wrong? So again, model testing, model validation is one of the fastest growing areas as far as ECL framework is concerned in the Indian scenario. Okay, so these are some of the things which I wanted to talk about. And this slide essentially shows you how the GCC versus the Indian banks compare and what is the demand in each of the markets. So as you can see, the model complexity in the Global Capability Center is relatively high, multi-jurisdiction global portfolio, regulatory exposure, they have different regulators. Team sizes are much larger in the GCC. And a lot of work in GCC is in-house, whereas in India, uh, a lot of work could be in the form of off-the-shelf product that you have bought from a developer, and then you calibrate it according to your own requirement. So again, I mean, the compensation and everything at the GCC level is much attractive, much more attractive compared to the Indian banks. And I also give you an idea of what kind of skills you need here. So that's pretty much all that I wanted to talk about. We started by talking about why ECL framework was required in the first place, what is the quantitative foundation, the PDEAD, LGD, and the discount factor using the effective interest rate method. Then you have the staging mechanism, the PIT versus TTC-PD, and how do you operationalize the framework. That is, I think, very important to get the data layer, the model layer, and the reporting layer all correct and at the same time. And finally, we looked at some of the roles and the career opportunities that you may come across and what kind of skill set you need to develop for that. So that's pretty much all from my side. Thank you very much. Over to you, Nitish.
Wonderful. That's actually very well summarized. I mean, both in terms of the domain side as well as the requirements, the careers. It's very well summarized. So, to the participants, I hope you found the session informative, and I can see some questions that have already come. And I'll request others also to maybe type in your questions as well. But in the meantime, uh, maybe also to give Ritesh a little breather as well. I mean, he has been speaking continuously, and maybe to utilize this time to just give a quick 2 minutes brush up on like how what we as an institute, how what we have been doing. So yeah, I mean, maybe a very quick intro about ourselves and what we have been doing and how we can help you move into this kind of fields that we have been discussing. I mean, even in risk management in general, or even credit risk in particular, right? So as you all know, I mean, I represent Indian Institute of Quantitative Finance. It's the oldest quant body in India, and we have been promoting education and training in this field of quantitative finance, financial engineering, risk management, uh, quantitative algorithmic trading, AI and ML in finance, and all of these areas for almost 2 decades now. And we were founded by people who are pioneers in India in the field of financial risk management and financial engineering, quant investment banking, and all of that, right? So not like boring you with all this stuff, but very quickly, those who have any interest in building your career in anything related to quant analytics, risk management, or pure quant domain side, or maybe in algorithmic trading or in machine learning, AI applications in finance, we have wonderfully curated programs which are all online, part-time, weekend programs which you can do along with your job or along with any other full-time degree that you are pursuing. And these are very comprehensive and actually prepares you with all the relevant jobs, right? So depending on your area of interest, which part of the industry you want to join, or what you want to do in terms of like your objective, right? So accordingly you can look at this courses. Very quickly I'll summarize the flagship programs. The flagship program, these are like, and yeah, very importantly, all these certificate courses are jointly certified by our institute, IIQF, and London Institute of Banking Finance. LIBF is, in fact, for those who don't know, it's one of the world's oldest finance certification bodies, established way back in 1879 in England by King's Charter, and more than 1.5 million people have done their certifications. It's a very established finance certification body, particularly in the banking space, right? So the certificate is jointly awarded by them, and for the flagship programs, once you earn the certificate, you also earn 30. I mean, you also earn CPD credits as well. CPD credits can vary from course to course, but you earn CPD credits which are approved by international regulators like OFQAL, and you can present it to, present anywhere in the world actually, for your employers or maybe for continuous professional development required by your other chartered courses and all of that, right? So very quickly, I mean, for people who are inclined towards very deep quants, mathematics and mathematical modeling, you have this certificate program in financial engineering, where we go into very deep maths and the mathematical modeling required for quant analytics and risk management. It's a 8-month certificate, 8 months weekend program. And those who are particularly interested in risk management side of the quant, and maybe also want to study the practical quant modeling skills without going too heavy into mathematics. So there's a course called Quantitative Finance and Risk Management, which is another course which is conducted on a weekend. So 7 months. Those who are specifically interested in trading or algorithmic trading, you have this course called Postgraduate Program in Algorithmic Trading, which very comprehensively teaches you all aspects on how to build algo trading systems. And of course, while you learn that, then you can actually you'd also learn how to do systematic trading using different kinds of strategies. And all these courses are taught by people who are all leaders from their respective industries. So you get not only to learn the field, but you also learn the practical aspects as well, right? And yes, apart from that, now since machine learning, data science has come up as specialized areas in every field and including finance, so we have specialized courses teaching data science, machine learning, and AI in context of finance. So those who are interested in those kind of things, they can look at this course called AI for Finance, which is of 10 months weekends. And those who don't want to go for the entire 10 months program, you can do shorter modules as well, the 4 months machine learning for finance module, or the 3 months data science for finance module. If somebody is already very well versed with data science, machine learning knowledge, then they can go into our direct applied AI modules, AI for risk management, particularly in context of today's session. If you are already working in risk, or you want to work in risk areas, then maybe AI for risk management is one of the specialization which is very important. And then you have other specializations as well. So basically you can look at this AI for derivative valuations, you can look at is generative AI for finance, or you can look at AI for trading kind of modules as well. Okay, we'll not dwell much into this. We have been fortunate to have thousands of students over the years, both students as well as senior working professionals, mid-level working professionals, even entry-level working positions as well. A lot of people have utilized our courses to make very good careers in the quant, risk, and all of these areas. So these are just a few small list of people who have been kind enough to share their thoughts. It's more for you to understand how you can utilize our courses. And yes, I mean, the courses is not like just for learning. I mean, you do have a 360-degree career support system as well. And it starts with the career counseling, which we do immediately when you start interacting with us, even before you join, maybe to understand your background, to suggest what kind of skill sets you need or what kind of field you can go. So we can even suggest that career directions as well. And of course, once you're part of the course, career mentorship is always by industry experts. So everybody who is teaching the course, they're all senior leaders from the industry. So just like Ritesh is, so there's like all faculties, they're all senior leaders from the industry. There's a dedicated placement support team. Once you complete the course, they can help you in the resume building, profile improvement, LinkedIn profiling, and then connect you with our strong industry association network and helping you actually sending your resume to right companies, getting you the interview calls. So they can help you in the entire process. I'm not going too deep into this. I mean, these are areas where we can target jobs, hedge funds, commercial banks, international banks, investment banks, asset management firms, fintech companies, financial software companies, stock exchanges, consulting firms like EY, Deloitte, etc. IT companies also, of course, Accenture and Cognizant to name a few. Right, these are different kinds of roles. Particularly if you are looking at the quant and analytics course, these are some of the areas which you can target, both in terms of quant research and analysis, as well as model validation, risk management, derivative structuring, quant trading, all of that. Right. Again, very small list of organizations which we have been working with. This is just a small list. I mean, being in the oldest quant body in India, the entire quant industry has been a connect, and we have been associated with the industry very strongly. Again, we do our bit in promoting this field of quant finance in India, and continue to do this effort and encourage students to also like understand this field and participate in this field, understand the career opportunities and all of that. So we work with a lot of educational bodies as well, and these are again a very small list of educational institutes which we work with. IIM Mumbai, NITI, which was earlier NITI, actually IIT Madras, IIT Roorkee, IIT Bombay, BITS Pilani, to name a few. Yes, and anybody who wants to connect with us to discuss our courses for guidance, or I mean, please feel free to connect with us on the contact coordinators that are provided here. Right. So with that, maybe let's go to the Q&A. So Ritesh, I'll collate the questions for you.
Yeah, I'm there.
All right. Let me collate the questions one by one. Okay. First thing, quickly to answer, Daniel has asked, will we get the slides used by Ritesh? Yes, you will be getting it. It will be shared in the LMS. So once you log in, you can if you have registered, you can log into the LMS, and inside the LMS you would get this your the webinars, this materials and all of that you can access. And in fact, those who have joined now, they can get the certificate also there. Okay, maybe let's go to the questions now one by one. Okay, so first question is also from Daniel, and Daniel is asked the timeline for stage 1, 2, and 3, 12 months and lifetime PD. Does it apply for short tenor loans like 7 and 14 days loans as well?
Sorry?
Could you hear my question?
No, I did not understand the question. Say that again, please.
Yeah, so I'll repeat the question. This question is from Daniel, and he has asked the timeline for stage 1, 2, and 3, 12 months and lifetime PD. Does it still apply for short tenor loans like 7 and 14-day loans as well? And if you're not understanding,
no, I understood. So what he's saying is that if the original loan itself has a contractual term of 7 to 14 days,
right,
then how will the migration happen? That is the question, correct?
Correct.
Okay. Now, strictly speaking,
yeah, just to so, Daniel, I hope that's the question, right? Which you want. And anyway, like again, if you need any information, or maybe if the answer is like again not matching the question that you have asked, please feel free to add to that. All right, please. Sorry, Ritesh.
Okay, so so first of all, it's a good question to have, because it has certain nuance. So this whole migration activity from stage 1 to stage 2, that actually does not happen for such short-term loans which Daniel mentioned, 7 to 14 days.
Right.
Uh, I think the more fundamental point is that when it comes to very short duration instruments, the entire stage 1, stage 2, and stage 3 framework, it applies very differently in practice, and in some cases it actually collapses. So instead of telling you how does it differ from the other facilities, let me try to share my views on how it happens for such very short term instruments. So by very short-term instruments, I mean short-term trade receivables, overnight interbank loans, when you do a payday style lending, or very short tenor bills discounting. Okay. Now they are typically assessed. So if you go to the IFRS 9 documentation, it includes something called a simplified approach. Okay. So in the simplified approach, the entity will always measure the loss allowance at an amount which is equal to lifetime ECL. Okay. So for many short-term instruments, what the bank will do, they will simply apply the simplified approach, meaning there is no staging at all. Every instrument is always measured at lifetime ECL, which for a 7-day loan is effectively a 7-day expected loss. Okay. So that is one thing, one approach in terms of how to treat such very short term exposures. I hope that answers your question. That is one of the approaches. There are other approaches as well, but I'm just trying to highlight how the simplified approach is used. Can you hear me? Hello, Nitish.
Oh, apologies. So yeah, I mean, Daniel says that it answers the question. So thanks, Daniel, and thanks, Ritesh. Uh, so next question is from Mitrajit. He has asked, "Hi Ritesh, are you referring stage 2 as SMA 0.1, 2? That is
Sorry.
the question. No. So the question Mitrajit has asked is, I mean, probably he is referring to that point when we were discussing the stage 2, right? So he's saying, are you referring stage 2 as SMA 0.1, 2? That's the
Yeah,
question.
typically, if you yeah, so typically, if you look at it, if you look at the guidelines themselves, so they tell you that the moment 30 DPD has crossed, okay, 30 DPD has crossed, you have to assume that there has been a significant increase in credit risk, and 30 DPD crossing essentially means the loan account becoming or the borrower becoming SMA 1. Now, having said that, uh, there there is no alignment as such between SMA and stage 2. The reason is they are not designed to align in the first place. SMA, or what is the special mention account, that is the RBI construct where you are trying to measure how many days past due the loan is today. So the classification is entirely backward looking and rule based, where SMA 0 means overdue within 30 days, SMA 1 is 31 to 60, and SMA 2 is 61 to 90. The moment the overdue will clear, and this is the more interesting part, that means the borrower will pay and regularize the account, the SMA classification will simply vanish. There is no memory of the past delinquency in the SMA framework beyond the current observation. So if you go and try to pull the acrylic records, it only shows you what the SMA status was in the most recent quarter. Stage 2 under IFRS 9, on the other hand, is actually trying to figure out using quantitative and qualitative indicators if there has been a material change in probability of default since origination. Unlike SMA, which is backward looking and rule based, this one the migration from stage 1 to stage 2 is forward looking and model based. I'll give you a simple example. A borrower has become 75 days past due on a home loan. So under RBI norms, it is SMA2. But when the bank does a significant increase in credit risk, they find that the overdue arose from a salary processing delay at the borrower's employer, not because of some financial stress. They find that the borrower's credit bureau score has not deteriorated. They find that when we originated the loan, the PD was say 70 basis points, 0.7%, but on the reporting date, the PD is 0.9%. So even though there has been a 20 basis point increase in PD, but the bank's threshold for migration from stage 1 to stage 2 is 50 basis point movement. Okay. So under Ind AS 109, the bank can document a rebuttal of the 30-day backstop, and they can conclude that no significant increase in credit risk has happened and keep the loan in stage 1. So the loan will be SMA2 under the RBI's framework and stage 1 under Ind AS 109 simultaneously. Now this is not a loophole. This is what is the intention is. The forward-looking assessment concluded that the past due status does not represent increased future default risk. However, the rebuttal has to be documented with specificity. That is the operative word, specificity. If you say that I am rebutting the 30-day backstop rule because of administrative delay and do not provide supporting evidence, then that is not going to survive auditor or regulatory scrutiny. Okay, so I mean, there are many such cases, and the point is, as and when the guidelines actually get implemented from next year, and we actually, get clarity on how the regulator will view these things, I think we will have a clearer picture. But right now, I don't think that there is a very clear alignment, because the two are not meant to align at all. So, I mean, I hope I have been able to give you some insight on that. I myself don't know, very frankly, how these things will be looked at by the regulator, because only once it gets implemented, we will be able to observe that. Okay. Hello, can you hear me, Nitish?
Yes, yes. Am I audible?
Yes, you're audible. And just to add a line to that,
Yes, please.
it's entirely possible that the account is only SMA 0. That means less than 30 DPD, but the bank estimates that the probability of default has significantly increased on the reporting date versus what it was on the origination date. It will still go to the stage 2.
Right.
Okay. It is
Yes.
also possible that the account is having 0 DPD, but the bank concludes that there is a significant increase in PD despite 0 DPD, say because of business stress, because of something which has happened to that industry, because of some legal action, because of some rating downgrade. The bank is still well within their right to downgrade the account and bring it to stage 2. Yeah, but yes, I mean, having made that nuanced distinction, I think that in practical life, people will be following some kind of mapping. So right now, if you look at Indian banks, all of them have internal rating models, but they do have an ad hoc mapping or an informal mapping to the external rating agencies model as well. That my master rating 10 say maps to a minus of CRISIL. That kind of informality will still continue, but strictly speaking, does it have a one-to-one mapping? It doesn't.
Wonderful. All right. So I hope that answers your question. This was a very comprehensive answer, actually. Right. So going to the next question, which is from Subodh, and he has asked, what could be the criteria for recognizing that there is significant increase in credit risk other than days past due. So you want to add anything to that?
Yeah, days past due though is an objective criteria that they have already missed the payment. So the model is the standard is very judgment based. Okay, there could be, so IFRS 9, if you read the document, it does not prescribe the criteria. It actually requires the bank to assess whether credit risk has increased significantly since initial recognition. Okay, so the standard is non-prescriptive. Uh, I would say uh, it could be because of multiple reasons. So DPD sounds the simplest and most obvious, but it could be because of change in the macroeconomic environment. It could be due to a rating downgrade. It could be because, say, someone has taken the borrower to NCLT. There are so many things which can, result in a movement to SICR. There could be uh, uh, the account has been watch listed, or it has been put in a credit monitoring list, or you have a sector or geographical stress designation. Say the the credit committee feels that a specific sector, say a commercial real estate CRE or the aviation or hospitality, is designated as stressed by the credit committee, then all exposures to that sector will collectively get transferred to stage 2 regardless of individual loan performance. That is a management overlay. Okay. There are covenant breaches. There is a significant deterioration in collateral. If it comes to SME portfolios, any significant adverse change in business or operating environment, say loss of a major customer, loss of a key contract, material adverse news about the borrower's industry. Technically, all these things can be taken as a justification for migration. Having said that, in the real world, I think banks, instead of becoming too subjective, because then it will open the Pandora's box, they will typically stick to criteria which are far more justifiable or objective. So DPD, of course, would be the key criteria in my opinion. But at the same time, if you have some significant event where there is no DPD and you still feel that the credit risk has deteriorated, you will still migrate it to the stage 2, because that is the whole purpose of the ECL framework. Okay.
Great. I hope that answers your question. And again, as I've earlier also mentioned, if anyone has a follow-up question, you can put it up, and we'll see if we can take it up, of course, provided time permits. Next question again from Daniel, very quickly. Are you seeing an increasing adoption of AI coding agents to this data and modeling layer?
Sorry,
Okay.
say that
Are
again.
you? Yeah. Daniel has
I can't
asked,
hear you.
are you seeing an increasing adoption of AI coding agents to this data and modeling layer?
I don't think so right now, because the bank being a regulated entity, see, when you say AI coding agents for data and model layer, everything that the bank does has to be in line with compliance with the RBI norms. I do not think that RBI still approves widespread use of AI agents in the regulated systems, but this will again depend on what kind of guidelines RBI comes up with. So I don't have a very definitive answer to that. If you really ask me what is my view, I would say I don't know right now. I don't have enough evidence to make a comment this way or that way. But yes, if
Definitely.
you are talking about the company which is developing the model, are their employees using vibe coding and all? That is entirely possible. But if your question is, would the bank delegate the job of taking a call on the migration, or taking a call on whether there has been a significant increase in credit risk to an AI agent? That is something where I don't think it is still possible. So I'm just making the distinction for you.
Yeah, maybe if you allow me just a quick add actually. To see essentially, like again, Daniel even if you see, yeah, traditionally they are not, I mean, traditional banks still actually, like, again, they can't, because again, there are a lot of regulations and all that. But there are a lot of ways that, I mean, banks are also trying to adapt, because, I mean, fintech has become a real threat when it comes to like lending and all of that. And this fintechs generally they learn on majorly AI models, and not, I mean, not much on the traditional models. So a lot of banks, particularly, I mean, we see international banks have, the adoption is more, but again, I mean, as we work regularly with like domestic banks as well, I mean, they are also exploring. I mean, in fact, RBI has a huge stress on training the banking man force in data science, machine learning, and related areas. So, I mean, some progress is definitely there. I mean, may not be directly exactly taking credit decisions, but a lot of other aspects actually they are doing. And even there, they are trying to, some of like the support adoption is still happening. Ritesh, just like my observations also, just I wanted to add to that.
Yeah. So, see, again, I don't say that, I'm not trying to say that banks are not using AI, but there are use cases. So, for example, where you have fraud detection models, where you have customer service automation, where you have credit scoring, or at the time of origination, or where you have KYC. There, banks are using AI, Gen AI products, and you already have the free AI framework of RBI. But as far as uh, computing the provisions, taking the regulatory decisions, I don't think RBI currently allows AI for those use cases.
Many,
That's the
absolutely,
point I'm trying to make.
absolutely. And I mean, so since Daniel actually has also mentioned in his next question that he works as a credit operations manager in a fintech. So in
Okay.
your kind of organizations, Daniel, I mean, you know better than us, me as actually, at least, that since you're working, a lot of these models are actually agent based and ML based, right? So yeah, I mean, but banks, as Ritesh mentioned, they're still regulated. But yeah, international banks, a lot of, I mean, the adoption is even much more. Okay, now going to quickly the next question. We are already, I mean, about time. Then maybe we'll take the next few questions quickly. Ritika has mentioned, I'm particularly interested in risk management course. I have no coding experience. Can you comment on Python used in this, and easy, hard, moderate would be to learn it? Also, the FRM topics embedded goes as well. Do I need to do it separately? Do you provide placement opportunities as well? Okay, so this is something we would discuss in detail one-on-one, Pritika, but very briefly to answer your question, yes, our course definitely, I mean, we use Python because our courses always invariably teaches deep theory plus the actual modeling. That goes for the risk management course, and I'm assuming you're talking about the quantitative finance and risk management course. So yes, Python is used quite significantly. However, said that, since these are courses which are attended by people from banking and finance background as well, so a lot of people join this course without any Python, or with zero, or maybe very less Python background, maybe, right? But what we do is we provide a lot of resources to learn the basics of Python, and then we expect the participants to use our resources and learn the basics of Python, right? And I mean, of course, for that you have to join few weeks in, or few 1 or 2 months in advance, so that you have ample time to join. We can discuss this in detail. I mean, basically your background, how you can do that, and how I mean, what kind of time you may require and all that, right? But yeah, I mean, in terms of your next question, how easy, hard, or moderate it would be to learn. So it has to be a step-by-step process. You learn the basics before the classes starts, then you continue practice, and then of course in the course you learn the actual modeling in different areas. So that, I mean, so initially you'll start slow as with everything, and then you will progress. So there is a process to that, right? And in terms of if topics related to financial risk management, no, of course, you don't need to do anything separately. I mean, whatever topics are mentioned in the course, those are all, I mean, of course, part of the curriculum, right? So, since you don't need to do anything extra. So, risk management is definitely a very significant part of the QFRM course. In fact, it's more than one third of the program. And in terms of placement opportunities, yeah, I mean, while I was presenting about ourselves, as I mentioned, we do have a support system on placements. So those who complete the course properly, we do have a dedicated team for that, and they can help you in the entire process, right? But more on that, we will discuss one-on-one. You can let us know your availability, and we can connect. One of the domain experts can connect and discuss all your queries with you. Okay. Uh, okay. Maybe going to the next question, which is okay. Uh, okay. Follow-up question from Mitrajit is: does Middle East conflict have any impact on ECL due to staging? Were you able to hear my question,
Does,
Ritesh?
does Middle East?
Does Middle East conflict will have any impact on ECL due to staging?
Yes, it can. I mean, see, one of the aspects in ECL is when you decide whether the borrower's credit risk profile has deteriorated significantly, you need to have a macroeconomic overlay. That means you actually overlay the macroeconomic scenario and try to then argue as to, given the macroeconomic scenario, what will be the change in the borrower's credit profile. So yes, Middle East conflict, if it continues for very long, and if it has a significant impact on certain sectors of the economy, then yes. But the whole point is, right now in India, this is a academic question because it will only get implemented from next financial year. But if the question is, in the eventuality of a conflict, will that drive the migration decision? Of course it will. And see, it's not that credit committees are not doing that already. So, I mean, when the Russia-Ukraine war happened, almost in every bank, the risk management committee would have asked their risk officers and the chief credit officers to run some kind of an exercise where, at least for their larger exposures, they would try to figure out what would be the impact of the Russia-Ukraine war in terms of availability of crude, in terms of price of crude, in terms of a general supply chain disruption as far as commodities are concerned, in terms of the INR depreciation. Right now, these activities were happening on a more qualitative basis. ECL will essentially quantify and formalize them. So it's not that ECL will do something which people have not been doing till now, but now you cannot, bring subjectivity to it. It has to be a more objective exercise. So I hope that answers the question.
Yes, I hope so. Okay, so going to the next question, which is from Richa again. So she has asked, what about GGC plan in this line? Chances of automation through AI.
What is
What's
GGC?
that?
Sorry.
Yeah, so I'll repeat the question. What about GGC plan? Goa Cadbury, right? GGC plan in this line, chances of automation through AI. Was that a what,
GGC or GCC, the Global Capability Centers. What is she talking about? Sorry.
Risha, if you can clarify? Yeah, it's GCC actually. I was also thinking so. Yeah. So what about GCC plan in this line? Chances of automation through AI.
See, ultimately, what the GCC is able to do or what the Indian banks are able to do, uh, that depends on the regulatory stance. Now, let me again bring out this nuance. I'm not saying at all that AI will not be used. See, when we talked about the ECL framework, we talked about a data layer, a model layer, and a reporting layer. Now, if you look at things like data pipeline automation, by data pipeline automation, I mean you create a machine learning based anomaly detection tool which identifies data quality issues in the loan level feed before it reaches the ECC model. Now, that is something which is practical, that is something which is explainable, and I think some of the GCCs are already deploying that. Or you can have Gen AI tools which help model developers to create model documentation from code and output. That is a productivity tool. Or you can have machine learning being used to generate alternative macroeconomic scenarios as input to the ECL calculation. So instead of only relying on your economist to generate the base case, the upside and the downside path, scenario generation. So all these are genuine use cases where ML will be used, is being used in certain cases and will be used. When I say AI agents will not actually get used in ECL, what I mean by that is, if your argument is that I can have an autonomous AI agent which will do end-to-end determination of which stage each loan should be assigned to, which will compute ECL, which will apply the overlay, and which will also produce the financial statement numbers without any material human in the loop oversight, that is what I'm saying is not a reality. So even when the agent comes into the picture for these activities, because it is a regulated business, you will always be required to have human in the loop oversight.
True.
But having said that, there are a lot of adjacent activities in which AI based coding, vibe coding, AI based automation will definitely be used. Ultimately, the bank will be responsible for the model output and for the regulatory reporting. And therefore, in my view, you will always need a human oversight. It cannot be an autonomous AI agent based activity. That's the limited point I'm trying to make.
Absolutely. Absolutely. Right. Okay. So I hope that answers your question. Very quickly now we'll take the next few questions, maybe in the next 5 to 10 minutes, because we have already past time. But I mean, it's good to have questions. It's like wonderful to see the interest, but most of it we have already answered. The questions we will maybe quickly answer as well. Okay, so the next question is from Amol. He says, "Hi Ritesh, thanks for this informative and thought-provoking session." Uh, Thanks, Amol. Great to know that you liked the session and you found it useful. So he says, "My question is, the internal rating model used by bank will produce PD. So is the
Hmm.
RBI circular talking about developing a new PD model?"
No, it doesn't matter what the RBI circular explicitly says it or not. The point is, let's let's first try to figure out where the Indian banks are today. See, you need models for two purposes: for regulatory capital computation, and for ECL computation. Now, the regulatory capital computation model for global banks who are allowed to use the IRB model, who are allowed the internal rating based approach, it could be foundational, it could be advanced. There, the regulatory capital is always based on a TTC formula. Okay. When it comes to India, you have an added nuance that you have an internal rating model, which is used to give you a borrower rating and a facility rating, which you use for internal sanctioning discretion, internal limit allocation, and all. But as far as the regulatory capital is concerned, RBI does not allow you to use internal model. They tell you that you simply look at the external rating, use that to compute the RWA or the risk weighted asset, and compute the regulatory capital. Now, having said that, my understanding is right now, the models which Indian banks have, they are essentially TTC models on which, again, the nuance is, because nothing is black and white in the real world, the nuance is that the model is predominantly TTC, but it does have some inputs of the current economic environment. It does have. However, to be technically very specific, it is not a PIT model. Whereas for expected credit loss framework, you will actually need a PIT model. So in my opinion, yes, the banks will need to have some kind of a change or addition to their existing model structures.
Great. Yeah, I hope that answers your question. Next question is from Subodh again. So just a quick question. Does a repeated management overlay a concerning thing?
Sorry, does a
Does a repeated does a repeated management overlay a concerning thing?
What does it? I mean, I did not get that question exactly. So, what do you mean by
Additionally, he
repeated
has
management overlay?
yeah. So does a repeated management overlay a concerning thing? And an added question, since it is there, it means there is something model is not able to capture. So these two questions put together, does it make sense? Or
Yeah, I was thinking about something. I was just thinking about the gentleman who asked the earlier question. So before I take this question, let me just add something to what I said earlier about the Indian banks. Uh,
sure,
see, the models that you have currently with Indian banks is a TTC calibrated system, which is primarily made for Basel capital purposes. Okay.
right,
For the RBI's ECL framework, they need PIT PD. Okay. But when I use the word new model, and that's why I'm coming back to the point, probably I might give a perception that new model means that the entire model has to be built from scratch. That is not required. What you will actually need is a new calibration layer, meaning a TTC PD can be calibrated to a PIT PD. And there are different approaches for that. So you have a scalar adjustment log, a scalar adjustment approach, you have a log odd shift approach, you have a Merton Vasicek Z score. So my point is again, new model in the ECL framework does not mean a new separate model, new model which will have new data from scratch. No, you already have a TTC calibrated system that you have built for the Basel capital purpose. For the ECL framework, you will need to calibrate that TTC PD to a PIT PD using the current macroeconomic overlay. So that I think was probably a better way to highlight this. Uh,
absolutely.
of course, of course, this is only applicable again. The nuances this is only applicable for good for the stage one. For stage two and stage three, you need the lifetime PD that currently does not exist. Again, in my opinion, it does not exist in any Basel model because all the Basel models they only produce 12-month PD, which means the survival analysis models that you need for stage 2 and stage 3 ECL computation, like the Cox proportional hazard models, that would be substantively a new modeling exercise for the banks. So just to get into that level of detail.
Wonderful. Okay. So
Okay.
coming back to
Yeah.
this
Now
question of
repeat the
Subodh,
question. हाँ, बोलिए, बोलिए.
he has asked just a quick question. Does a repeated management overlay a concerning thing? Since it is there, it means there is something model is not able to capture. So that's his two-part question. Does it
Okay.
well to understand?
So if you can ask him, I mean, I really did not understand what he means by a repeated management overlay. What does it mean?
Subodhi, if you can kindly elaborate on exactly what you have meant by that. Subodh, are you there? Yeah, hi Subodh. We are trying to answer your question, and are you able to hear us? If yes, then please do respond by providing the additional information that Ritesh is
Okay.
requesting.
Okay. See, I will try to answer it in a limited way.
Okay, so,
I'm
so
just
he
trying
he has
to.
added to that his question. So he
Uh,
mentioned if there is maybe quarter on quarter basis.
okay, now I don't look at it in that perspective. So I will give you what I think of this question, and probably we can then see what he thinks about it. So see, when you talk about a management overlay, first of all, let me define what I mean by management overlay. By management overlay, I mean a single overlay which has been applied to the model in response to a well documented, specific, and time limited event. For example, COVID forbearance or a sector shock. Meaning, IFRS 9 documentation explicitly permits post-model adjustment. By management overlay, I mean post-model adjustment. This is very similar to, in my opinion, how management is able to do a rating override. So whatever rating model throws as output, you do a rating override. So IFRS 9 tells you that in some scenarios, when the model inputs do not capture all the relevant information, say a one-time scenario like COVID forbearance or like what has happened in US-Iran case or anything like that, you are allowed to have post-model adjustments. Okay, so that is my definition of management overlay. Now, if that overlay becomes recurring, then of course, in my opinion, that is a significant red flag. Why? Because if you keep doing repeated overlays on the same portfolio segment quarter on quarter, to me, it tells that the underlying model has a systematic error. It is not capturing the risk which the management thinks exists, but the model is not able to capture it. So the
Right.
correct response to fix the model and not to paper over the gap every quarter with a manual adjustment. So to me, if I am a regulator or an auditor and there is a recurring management overlay on a quarter to quarter basis, I will see that as a model deficiency which the bank is not acknowledging in a formal manner.
Right.
So that is there. And furthermore, as a regulator or an auditor, I will always have a concern if the management overlay is recurring. My fear is, are you applying this overlay repeatedly in a direction which is convenient for your reported profits? That means in a good quarter, the overlay gets reduced. In a bad quarter, the overlay gets increased. To me, it creates a perception of provision smoothing. I don't know whether that is
Right.
the intent or not. So yes, it is a red flag. And if you read the 2026 April RBI final master direction on the IRAC norms, it clearly says that a bank has to maintain the entire inventory of models and they have to implement structured validation and monitoring frameworks. Okay, so if you have a recurring overlay which has not triggered a formal model review, then I believe that when the regulator examines your ECL governance norms, they will flag it. That if you
Right.
had a recurring overlay, why did you not do a formal model review and fix the problem in the model itself? So I hope that answers the question.
Yes, I think so. Okay, so maybe the we'll come to towards the end of the session. Let's take like one more question from Mitrajit, and maybe we'll wrap up the session. So he says that since NPA is tagged on borrower level, so how will you justify one account if that gets defaulted due to a credit card default? Will you consider the associated mortgage account with it as stage 3? Also, if the account gets upgraded in terms of the IRAC norms, then will the stage gets changed in terms of stage 1 from stage 3 for ECL calculation? Very long question. Do you want me to repeat it?
So I think, just correct me if I'm wrong here. My understanding is that he said that a borrower has a certain several banking products. What happens if, say, he has become a defaulter on credit card? So will the entire borrower get tagged as NPA? Was that the first question?
Yeah, I think so. That is what I could also understand. So just to repeat, NPA is tagged on borrower level. So how will you justify one account if that gets defaulted due to a credit card default? Will you consider the associated mortgage account with it as stage 3? So that's the first part of the question.
Yeah, I think so. So to answer that, yes, because see, credit risk is not only about capability or capacity to repay; it is also about the intent to repay. The whole idea
Absolutely.
of the ECL framework is, I mean, it would be very bizarre that there is a borrower who has defaulted on his credit card payments, and the bank who is holding the retail mortgage will argue that no, the credit risk has not changed. That is the whole idea of doing an NPA level borrower tagging. Either you are an NPA as a borrower or you are not. You can't
Right.
say that I am NPA on one product, but I am not NPA on another product. So that is first part of the question. That if I am a credit card defaulter, what will the retail mortgage lender do? If I am a credit card defaulter and my CIBIL shows that I have a certain number of DPD, that means my credit risk has significantly increased. And for the
Absolutely.
second part of the question, once I have cleared my dues, the upgradation to stage one, is that what you're saying?
Mitrajit, is that the question? Did we get the question correct?
Okay,
Yes.
I think that is what that is
Yes.
what he
Yes.
exactly
That's the
asked for.
question.
So, so again, I mean, uh, see, fundamentally, yes, but with a nuance. I will just tell you how it will work. See, under the RBI's guideline, NPA classification, as we mentioned ourselves, is applied at the borrower level. So if one facility of the borrower has defaulted, then all facilities of the borrower are classified NPA. Under IFRS 9, the staging is applied at the instrument level. That means each financial asset is assessed individually for credit impairment. Now, what this means is, see, under IFRS 9, a stage 3 asset can return to stage 2 or stage 1 only when the conditions that caused the original credit impairment no longer exist. And plus,
Right.
the improvement is not expected to be temporary, the improvement is expected to be sustained, which means the bank's forward looking assessment has to genuinely conclude that the borrower is no longer credit impaired. It simply cannot be the case that a past due amount has been cleared. See, what right now happens is, if the account is NPA and once the borrower clears the entire NPA thing and the account gets regularized, you can directly migrate it to a standard account. But in the ECL framework, when you have to migrate it from stage 3 to stage 1, the bank actually has to assess that not only that, the idea is that simply because someone has cleared the due is not proof enough. You also have to justify that there has been a material change in the credit profile itself. Now, IFRS 9 does not prescribe some kind of a mandatory probation period. So IFRS 9 documentation does not say that what is the probation period where you have to continue to keep it in stage 3 even though all dues have been cleared. Okay. My understanding is that as a market practice, the minimum cure period is somewhere between 6 to 12 months. That means even though all the dues have been cleared, say for 2 quarters, the regulator will expect, the auditor will expect, or what is the market practice is that you will continue to classify it as a stage 3 asset before you can do a back migration to stage 1. Of course, I mean, for India, how it will evolve as a practice, that we will only get to know once it gets implemented here.
Yeah, absolutely.
Also, in practice, one more nuance, probably I think banks, instead of doing a direct upgradation from stage 3 to stage 1, it will happen from stage 3 to stage 2 and then from stage 2 to stage 1. So the
Yeah,
full cure journey will move in that direction.
yeah, absolutely. Right. Okay. So I hope that answers your question. Okay. Actually, like again, one follow up from Venkata. He has says that I really enjoyed the session, cleared many of the doubts. Wonderful, Venkat. Like great to know that. So he has asked two questions. What is VIS stress test method? VIS stress test method. And
What
second
is?
is he has written a short form. What is no, so what? Uh, I think there's a typo, Venkat. If you can actually correct that, I think it meant try to write what is stress test method. because that question is not clear. So if you can correct that. Second part of the question, maybe are there any courses from IIQF for internal auditors to evaluate whether the ECL model is working in an institute? IIQF is actually coming up with very specialized short modules, including ECL. But again, as of now, it's not there. But again, over the next 3-4 months, you would have a lot of advanced risk management and related courses which would be added up, right? So as of now, we have this very comprehensive full course called Quantitative Finance and Risk Management. But this time, for specialized modules are actually also going to be added. But in the first part of the question, if you can clarify what you wanted to mention. Oh
VIS
yeah, he
stress
has
test.
corrected actually. So he has corrected. So it means that what is stress test method? It's not base. It's
For
is.
what?
Yeah, and what is the stress test method for? In what perspective, Venkat? If you can kindly add up.
So I think probably he's asking in the context of the ECL itself. So I will answer that. See, when it comes to stress testing for ECL, it is about estimating how the provision would change under adverse macroeconomic scenarios. So there is a macroeconomic scenario which is the base case for a standard ECL calculation, and the regulator might tell you that you also estimate what the ECL would be under the adverse macroeconomic scenario. That I think is the stress testing. Uh, what is the distinction here? See, the standard ECL calculation is actually based on forward looking information. So you have a probability weighted scenarios, the base scenario, the upside and the downside. But when you do stress testing, you ask what happens under a severe scenario that is outside the probability weighted range. Essentially, you're looking at a tail event. Okay. The stress test is not booked as a provision. It will never get booked as a provision because then that will be
Right.
too much of a provisioning. The purpose of a stress testing is to inform the management, board, and regulatory decisions about capital adequacy and how resilient your model is. Okay, so I think when it comes to the ECL framework, there could stress testing will have three use cases. One is you shock the macroeconomic input, the GDP contraction, the unemployment spike, the housing price index decline, interest rate rise. You shock them beyond the downside scenario which you used for the standard ECL calculation, and then you observe how the PDLGD and staging migration will evolve. Essentially, this is telling you how much provisions could increase in a severe downturn and whether the bank's capital base can absorb it or not. Then you
Absolutely.
might have a stress run on the SICR. That means the significant increase in credit risk threshold, where what you do, whatever is the existing SICR threshold, you run it through a stress scenario, and then you measure what fraction of the portfolio will migrate from stage one to stage two. Here, the objective is to figure out whether the threshold that you have decided for migration from stage one to stage two, whether that threshold is calibrated appropriately or whether that threshold will produce a sudden spike in provision when you have the first downturn. That is the cycle threshold ka stress. And then the third kind of a stress testing would be where you shock the individual model parameters. Say you increase PD by a fixed percentage, you increase LGD by a fixed percentage, and all this you do independently of macro scenario. There, the perspective or the objective is to figure out which parameters of your model the ECL calculation is most sensitive to, so that you know what are your model risk management and validation priorities. So these are three, stress testing related stuff that I can think of. One from a macro scenario stress, one from a cycle threshold stress, and one from the model parameter stress. So I hope that answers the question.
Right. I hope that answers your question, Venkat. All right. So anyway, with that, we have actually taken up all the questions. In fact, there are one or two questions remaining, but those are repetitive in nature. So I mean, we have already covered answering those. But apart from that, we have taken all the questions. So thanks, Ritesh, for patiently taking your time out and for answering all the questions. It's deeply actually, right? So and once again, thank you for joining. It was really an insightful session, and thanks for all your answers and explanations. And to the participants, once again, thank you very much for joining, taking your time out on a weekend, and joining us. Look forward to see you again in the next sessions. We regularly conduct sessions, important sessions on various important topics related to risk and quant and algorithmic trading, machine learning, and all related areas in finance, right? So keep track of our website, keep track of our social media pages, and we would also intimate you of the next sessions. So yeah, feel free to join all the sessions. So look forward to see you again in the next session. Thank you. Thank you all.
Okay. Thank you, everyone. Thank you. Bye bye.